right. Happy Friday, all you magnificent melon heads out there. Hope you guys are well. A lot going on today. Big jobs report came out this morning. Stock markets took one look at that jobs report and said, oh, hell no, I'm out of here. Down, down, down we go. Last I looked, we were down 600 something points in the Dow. Everything heading lower. Just about every one of the indexes looks set to retest those lows. I mean, we are like literally right back where we were last Friday when the last time I told you, don't look down. Don't look down. We had a nice run up midweek, had a couple of days. I remember a couple of days ago, Mish and I were talking about, hey, are we going to have to do a spontaneous live stream to go up 1,000 points? Well, we went up for a couple of days, changed direction on a dime, and we're heading right back down. And now here we are where we were a week ago, where we were back on June 14th, set to make some new lows for the year. And we're going to look at the charts, folks. There is a lot of room down below here. If these levels do not hold, and I have no reason to think they will, we're going much, much lower in all of the indexes. And the only thing I think that can stop it, it's going to be short-lived. All right. The only thing that can stop these markets from going significantly lower in the short term is going to be a much lower than expected inflation print on next Thursday. We got our CPI print next Thursday. We're currently sitting at about 8.3% year over year inflation, which is down from that all-time high of 9.1. I say all-time high. We've had higher CPI prints in the past, but they've changed the methodology. Inflation has never been as bad as it is right now, not in the States. Well, we have until next Thursday to get that number down, because after this next CPI print, which I do expect to come in a little bit below the September number, this print will be the September number, so we'll say compared to the August number. I expect it to come down just a little bit, and then look out because inflation is going to come roaring back. I've been talking about this for months on this channel, that people think peak inflation was behind us. Remember, Jim Cramer was talking about peak inflation for like 2 years now. Oh, we got 2 lower CPI prints. I guess the worst is behind us. No, not with this circus going on in Europe. Not with what happened to oil. By the way, how do you like that oil bottom? Remember, it was a week ago I called the bottom in oil. Yeah. No, folks, inflation has not peaked. We might get a lower CPI print next Thursday, and it might take stocks a little bit higher if that happens. But just wait, because these numbers this fall and through this winter, with everything going on in Europe, with the oil market doing what it is, and the SPR dumping scheduled to end soon, even if they extend it by another 10 million barrels here or there, oh no, the inflation is coming back big time. And everything the Fed is doing right now to fight inflation, everything they're trying to do to slow the tightness in the jobs market, that jobs report we got today says it's not working. So there's a lot of people are calling for the Fed pivot out there right now. It's not happening, folks. The Fed will not be pivoting anytime soon. And look, if you're one of these guys who's like, I'm going long stocks because I think the Fed is going to pivot soon, they're going to turn the money printers back on. The only way you're right that the Fed is about to turn the money printers back on is if something so awful happens in markets in the next few weeks that all of your calls go to zero anyway. So if you're long stocks right now because you think the Fed pivot is coming, even if you're right, that is not good news for you. That is terrible news for you. Because the only way the Fed does pivot is if the pensions blow up or we get some kind of liquidity freeze in credit markets and stocks start dumping by thousands of points within a matter of minutes. You don't want to be long. You don't want to be sitting on calls when that happens. Anyways, folks, that's what I got to start us out today. Let's bring in my man Mish here. Let's look at some of the charts we got going on. How you doing today, Mish? We got a muted Mish right now. There he is.
Muted. Okay. So, yeah, I'm doing pretty good, man. I'm in Lockhart, Texas.
Lockhart, Texas. And, folks, if you're looking for a Mercury dime, track down Mr. Mish somewhere in the region of Lockhart, Texas. He's got a Mercury dime for anybody who spots him in the wild. And I got to send it.
Hold on. I would like to say thank you to 2 things that have happened in the last 24 hours.
Okay.
One is going to issue, so deal with it. So, yesterday, Biden pardoned all nonviolent marijuana federal offenses last night. Yeah. And that's pretty big news in the fight. Several of our chat guys are in the fight.
And At risk
But
of getting my channel flagged for discussing off limits topics, I'm actually in favor of that. I see nothing wrong with that. Long overdue. I think it is long overdue. Certainly a step in the right direction, even if a politically desperate move, but it's still a net positive. So, what was the other one?
the other one, they're saying that I need to come up in volume a little. The other one is that about the pivot. It is way too hot of a labor market to even think about pivoting yet. He can't. They may be the last ones raising because they just literally can't. If they lower now, it's going to make the labor market hotter.
That's
And
right.
they need to come up 4 to 4.2 unemployment just to get back to neutral. Talk to
And,
Phillips.
and oh, there you go. You're trying to trigger me with that Phillips curve again. There you go. So here's my biggest gripe with everything the Fed is trying to do is the Fed is attacking labor demand. They're trying to crush demand for labor. And they're trying to prevent wages from rising by crushing the demand for labor. And they think that's how you fight inflation. That's how you cause massive misery in society. All right. Forget your dual mandate for a second. Forget the academics of it all. What is it we're trying to accomplish? We want prosperity. We want people's lives to be better. All right. And we want to do that in a responsible way, not just printing money and helicoptering it to people. Right. What the Fed is doing is they're attacking the demand for labor. Why don't they try expanding the supply of labor? Because everything they're doing right now, with all the inflation that they created, and American businesses are very reluctant to raise wages. We will get into that a little more today. Wages have only risen 5% this year, while inflation headline is 8.3%. Actual John Williams shadow stats is closer to 18%. People's lives are getting harder. So how are you going to expect more labor supply if the benefits of working are going down? That's not how you get more people to come back to work. And look, I'm not one of these living wage at Burger King kind of people, right? Like my first job, I was a busboy for 1 year. I was so bad at that. I just spilled drinks on people. And then I worked at Burger King flipping burgers when I was a teenager, right? There's people out there who think you should be able to support a family of 4 flipping burgers. No. Flipping burgers is not a job where you can have a nice house and raise children and support a whole family. You're supposed to aspire to be more than that, okay? All right, when I was 14 flipping burgers, that wasn't where I wanted to be in life. All right, I've moved on, thankfully, to bigger and better things. You shouldn't be able to support a family of 4 flipping burgers. All right, that's how you get job skills. That's how you become a better employee. That's how you add more value to society. You have to start somewhere. All right, so I'm not one of those people who's like, you need to make $100,000 a year flipping burgers. But at the same time, look at the numbers. Look at workforce participation rate. Look at people leaving the workforce and not coming back. It's not worth it to work right now for a lot of people. It's just not worth it. And the only way to get those people to come back is for their wages to rise. And if wages don't rise, we cannot expect the supply of labor to increase. All right? That's just not how supply and demand works. And I just don't see it. I see the Fed is all focused on the demand side. They're ignoring the supply side. And look, we've got onshoring going on right now. We've got deglobalization going on right now. Factories are coming back. That CHIPS bill that just got passed, which was very inflationary, the CHIPS bill, but it was necessary for national security. And now Micron is building this $10 billion plant in New York. Well, that's more demand for labor as these factories and as these jobs and all the stuff that's been outsourced for the last 20 years, now it's coming back. That's going to expand the demand for labor. So for the Fed to sit there and say, we're just going to keep wreaking havoc with the economy until the demand for labor goes down, they're fighting against the current. It's not going to work. You cannot reduce the demand for labor in the United States right now. It's going to keep rising. So the only way to restore balance to the labor market is for the wages to rise. And that means you need to eat a little wage spiral inflation. Sorry, Jerome Powell. You created all the asset inflation with your stupid money printing and your low rates. And you were fine with that because your stocks were going up in value, stocks you sold a year ago right before you stopped the money printing. Then it turned into consumer inflation and everybody's lives got more difficult. And now it's about to affect wages, and you're like, no, 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 we got to stop. Well, you can't cut people off right before the inflation starts to at least benefit them a little bit, because right now people have just borne the cost of inflation with the higher cost of living. They have seen none of the benefits of it. You can't just shut it down now. You have to let the wages rise. You have to let people, you have to give people hope, right? And like all this, like job quits are up and the phenomenon of quiet quitting where people just do just enough to not get fired. That's people losing hope. That's people refusing to do any more. They're not going to burn the candle at both ends and work their butts off. It's not going to get them anywhere. And because of that, your productivity is going to go down. And if you have wage gains and productivity decreases, wow, that's very inflationary. So the Fed is going about this all wrong, if you ask me. All right, that was a long tangent. Very long
Right.
one.
Two ways to create unemployment is either one, from the bottom up with the wage push economic type scenario, and then what they're doing, which is a liquidity scarcity push down and then yank it back up because there's nothing else. So instead of the workers gaining momentum on their wages, the businesses are gaining momentum on their side, and we just get screwed.
Yep. And you know, there will be more consumer inflation. If wages rise, that does mean costs will be passed on to the consumer. That means inflation is going to be here for a while. And you know, that's why I keep saying get used to it, folks. Inflation, you know, it's not going away. I don't care how many times Jim Cramer tells you it's peaked. It's just not going away. It's here. It's here to stay. All right, I got to thank Mr. Mike Kathman here. He's been up on the screen for a little while for his super chat. Thank you, Mike, for the support of the channel. He says, thanks, Jack, for the DVN. Saw where the U.S. is wanting to play hardball with Saudis. The actual number of barrels ain't changing that much, and it's stupid. All right, so DVN, that's ticker Devon Energy. All right, that's one I talked about on my stream last week. I also talked about that on my Patreon with my Patreon supporters a couple of days ago. By the way, thank you to my Patreon supporters. Thanks for everything you guys do for the support of the channel. Hi, Mom and Dad, by the way. I forgot to say hi. I love you guys. So Devon Energy was one of the ones that I liked. I did a video on my Patreon page a while back about some of the different options to invest the oil trade. And I realized that Devon Energy, when oil was selling off through most of the summer, Devon actually did pretty well relative to USO and some of the other oil majors and the ETFs. And then during the run up at the start of this year, Devon actually outperformed a lot of those also. So the risk reward profile for Devon Energy, I really liked. I bought shares in Devon because I liked the dividend and the history on that one. So Devon Energy was one of the trades I made. I'm currently up 17, 18% on that one. I also bought some call options in ERX last week. I sold some of those yesterday. Did really good. Those are up. Almost quadrupled my money on those. I sold half of them yesterday. I still have half of them in play. Although you're going to see today, oil is way up today, but some of the oil stocks are down today. So keep that in mind that these oil companies are still vulnerable to the prevailing winds in the stock market, even though the underlying commodity might be going up. That's something you got to watch out for. But glad that worked out for you, Mike. And thanks again for the super chat. And I just got to remind you folks, always do your own DD, your own research, and arrive at a decision right for you based on your unique situation. I get them right every now and then. I get them wrong every now and then. So don't just follow me into trades because you heard nobody special talking about something on YouTube. Always do your own research. And if you see something I'm missing, point it out to me. I love to hear from you guys.
And never forget about the wave also.
I'm sorry, what was that?
The inverse Mish ETF.
The inverse Mish. The IMI, the inverse Mish indicator. And I got Crushing Bear, who I was also talking to Crushing Bear in my Patreon this week. He says, shout out to Jack's Patreon. Very informative. Thank you, Crushing Bear. Appreciate the super chat and appreciate your support of the channel through Patreon. He was on the on our Zoom call that we had on Wednesday this week. It was nice talking to you, sir. Thank you very much. And I saw you in here somewhere, Cheeseburger. Where are you? There he is. There's my man, Matt, the Cheeseburger. He says, can you see any pattern emerging on the MMRI chart? I shared an image of it on the Discord if Mish can get it to you. Mish, see if you can shoot that to me somehow. Put it maybe in the chat or something, if you know where that is.
Streamlab private chat.
Oh, okay. There it is. See, he's already out in front of that. He's looking at these things before I even do. All right, give me a second here. I've never seen this chart before, so doing this one live. I hope you don't stump the dummy here. All right, do I see any pattern on the MMRI? And that, if you're not familiar, the MMRI is the Mannarino Market Risk Indicator. This is created by Greg Mannarino, who is, I don't want to say a good friend of mine, but certainly a friend of the channel. He's been very good to me. I made the MMMRI a few months ago, and he was nice enough to share that. That was a big day for this channel. All right, so Mannarino's indicator, just looking at that, that is a, I can't draw on this one because this is a JPEG, but I can tell you here what you're seeing at the very end these last few weeks. That's a pretty clear bear flag pattern if I ever saw one right there, that little pullback. Definitely a continuation pattern. So I would say this thing is going to head higher. And, you know, look, this is going to head higher as the 10-year yield, which is really the main input to this. The MMMRI is the Dixie times the 10-year yield divided by the golden ratio. And, you know, the 10-year yield's going to keep heading higher. The Dixie's going to keep heading higher. So I expect the indicator will continue heading higher. Definitely see a little bear flag pattern there. So that's what I would say based on that one. And thank you very much, Cheeseburger, for the support of the channel and for sending me the chart. I just love looking at charts. And let me bring the comments back up. I think I got everybody in the supers that left one. I don't want to miss anybody. Okay, I did. So now that we're there, let's take a look at what's going on in the indexes right now. S&P is right now at the low of the day and heading lower, it looks like, down 121 points or 3.25%. Awful, awful day in the S&P. And there you can see that big leg down this morning right after the jobs number came out, and we just continue to make new lows now heading into the last half hour of trading. Dow not faring much better, down 769. Are we going to have a 1,000-point down day? Is that going to happen while we're talking here today? Currently down 2 points.
People are watching. It popped up to 800 already.
Wow. So,
are we down for the week yet?
For the week, I don't have it up on this chart. I will have it on the other one. We're right about there. We're like right there. Let's see. Here's the Dow chart. Let me set this to a 5-day. The Dow is still a little bit higher than we started the week at. Just a little bit, not by much, Mish, not by much at all. And we're definitely going to be retesting those lows. Let me bring up my year chart again. We'll get back to this one because I didn't go through the NASDAQ, currently down 10. Hold on a second. Currently at 10,610. The NASDAQ is down 462 points or 4.18%. And, you know, lately, I like to chart the NASDAQ, folks, because the NASDAQ, I just heard Rafi Farber say this on Arcadia Economics earlier today. The NASDAQ, that's your bubble index, right? The NASDAQ is the one that blows out to the most ridiculously high multiples. It's full of these high-flying, debt-heavy tech stocks. They're dependent on the flow of easy money, on cheap interest rates. So they're going to take the biggest hit in this rising rate environment. So I've been spending a lot more time charting the NASDAQ than I otherwise typically would, because I think the NASDAQ is going to be your leading indicator right now. It's the most vulnerable to these big swings in the debt market. And right now, the NASDAQ leading the way lower. That's what I would expect. Currently down at 10,611. And let's take a look at this. This is the NASDAQ also. This is zooming all the way back out to like 2019 timeframe. And you can see we are right here. I drew this line last week. We're like right back where we were last week, retesting these lows from June. And I mean like within 50 points or so. If this level does not hold where we're at in the NASDAQ right now, if we keep heading lower, I don't see any support anytime soon from a technical basis. And I've been saying it for a while, folks. We are going to retest those lows from March of 2020, from the unfortunate health situation. We are heading back to those levels before this whole mess is behind us. I think it will get that bad before the Fed turns the money printer back on. And that's down like another 30 some odd percent from our current level. And that's why I said look out below in the thumbnail for this live stream, because we could go much, much lower from here. Remember, the Fed sold their stocks. They do not care about your 401k. The Fed is more worried about their global reserve currency. The Fed is more worried about the debt market, the government solvency. They are not worrying about your stocks and your 401k right now. Don't think these people care about you. They do not. And I got to send a shout out to Mr. Jose Orozco, the keeper of Bucky's Corn Nuggets. Says Powell and Fed have early demand destruction for Christmas. That is certainly on their Christmas list. Again, I think the Fed is all wrong. They're all focused on demand side of the equation right now. They need to be focused on supply, because once you realize the supply dynamics that are in play right now, Jose, the inflation is going higher no matter what they do to demand. It's going to keep going higher because globalization is in reverse. All those outsourced jobs of the last 40 years are coming back to the U.S. We have to start making our own stuff now because we're on the brink of World War III, and global trade cannot be guaranteed. Supply chains are not secure. You need to make that stuff in safer locations. That means more expensive labor. That means more demand for American labor. Wages are going higher. So, look, it's good for the American middle class. What's left of it, maybe the American middle class actually has a chance at making a comeback here if we don't destroy the whole economy and we don't slam on the brakes. We let those jobs come back. We let those wages rise. Yes, it means more expensive stuff. All right. It means you can't get a toaster for $8 at Walmart anymore. But you know what? Would that really be so bad? Would it really be so bad? Back in the 80s when a toaster cost you whatever $1980 were, right? It was a little more. Was life really that bad back then? I can tell you a family with one parent working could survive back then easily, live in a nice neighborhood where mom could still stay home and take care of the kids, or dad could, it's the 21st century. I get it. Dad could stay home and take care of the kids. That kind of thing is perfectly understandable, but it's not like now where both parents can work their tails off and still be broke at the end of the month. So maybe if we trade in the cheap crap at Walmart for a slightly better standard of living, I don't think that would be that bad. So thank you, Jose, for the super chat and the support of the channel. I don't agree with the Fed's approach that destroying demand is the way to go about it. Let's let the free market determine the price of money, which means stop rigging the interest rates. Let them go higher if they want to go higher, and then let the market reward good investment instead of rewarding bad investments and stupid debt. And I got my man, AK.
Yeah, AK, I'd like to talk about it after I read it.
Okay, he says GBP, which is the British pound to the US dollar, is unstable. I would say their problems have not even started yet. All right, Mish, go ahead, take that one away, and I'm going to bring up the chart of the pound while you're doing that.
Okay, so they started with pensions 2 weeks ago. They had that pension problem. They never actually fixed the pension problem. All they did was put it down the road. So we're talking trillions of dollars here. You just can't unload that over a 2-week period. So the theory is anything that happens in Europe happens here. So everything that's getting done in financial institutions in Europe, we do it the same way over here. We have the same pension problem ready to roll. And Britain is still fighting theirs. They're going up 3-4 cents in a couple of days here, like a fire hose that just got cut off. It's coming.
Absolutely. Absolutely. I mean, England hit their level first. They hit their threshold first. We use the same broken system in our pensions here, this liability-driven investment. Our pension funds in the States use that same strategy. So the pound is just an early indicator. That issue with the UK pensions will rear its ugly head here. And, to your point, AK, when you said it's unstable, we're looking at the strength of the pound against the US dollar here on this chart. And you can see back here, this is last week when they had to bail out the UK pension system. The pound just was in free fall here. So the UK government, they stepped in. They started buying UK bonds, the gilts, their long-dated treasuries. That stopped the bleeding. It stopped the panic, at least in the short term. But you notice the pound, it's trending back down now over the last few days. And you can kind of see this same thing here in the Dixie chart, or the DXY. You see the dollar, it cooled off a little bit. It came down for a few days, but now we're heading back up for a couple of days in a row. The strength in the dollar, let's just zoom out here. Look at this on a one-year chart. I got to zoom out a little bit on this one here. Folks, the US dollar, the DXY, is going to continue heading higher. Look at that hammer pattern right there. Pretty clear rejection of that lower level. This thing is heading up, and it's heading up in a big way. So the trouble in the UK, Mish, you're right on. It's not over. It's not over for them, and it is not just a UK problem. You can bank on seeing some form of what happened there here in the States. And Mish says 4 to 6 weeks, which would mean that is now 3 to 5 weeks away. Interesting. Interesting. Thank you very much, AK, for the support of the channel and for the super chat, sir. Very much appreciate it. And I saw Mike Robin and Mike Binder. I always call him Mike Robin. Thank you very much, Mike, for your support. And he says the 30-year hit 3.9% in the U.S. Buy homes or commercial real estate now. Not so sure I'd follow you into that one, Mike. China froze the FX to the USD. They can try. They can try to freeze it. All they can do is dump their reserves, though. Shipping volume down a lot. What are you selling for profit in 23? Ugly. All right. Well, I can't tell you, a lot can happen between now and 23, so I can't tell you what I'll be selling back then or, a few months from now. As far as China freezing the FX, China, they have their foreign reserves. They have about 900 billion of U.S. treasuries. They can sell those for dollars and then sell those dollars to buy yuan. That can prop up the yuan a little bit, but eventually you run out of those USTs. You run out of those treasuries. Japan is doing the same thing. These are only temporary stopgaps. What China is doing, China is loosening their policy right now. They're lowering their reserve requirements. They're injecting capital into markets to try to stop their debt bubble from blowing up. It's not going to work. China has their own series of economic problems. We've talked about it a lot on this on this channel. That problem hasn't gone away. It just looks like Europe is going to hit first. There's this three-way battle for who's got the biggest economic CF in the world right now. You've got the U.S. with the liquidity trap at the Fed. That's going to cause problems eventually. You've got China and their housing bubble, which is, in my opinion, the biggest bubble in history, the Chinese real estate market. That's going to pop at some point. It's in the process of popping. And then you have what I think is probably going to win the race and blow up the global economy first, the European energy circus. And, we almost got there with that UK pension system. A lot of that had to do, the press, they blamed it on the tax cuts, and the tax cuts was a factor in that. But also the fact that the Bank of England is going to have to print money to try to fix the price of their energy this year. That's not going to work. That's another reason why the pensions were blown up, why their yields were blown out, and why the pound was tanking. So I think Europe will probably win in that three-way race. But as far as buying homes or commercial real estate, not in the U.S., buddy. Nope, not with my worst enemy's money right now. Fact is, affordability. People cannot afford homes at these prices and these interest rates, and the interest rates are still going higher. The Fed's going to keep hiking. And also keep in mind, the interest rates on the mortgages are rising faster than the Fed is hiking. The spreads are blowing out. That means the banks see more risk in real estate, and they're demanding a higher premium for that risk. So I wouldn't touch anything having to do with real estate. I did get a couple of real estate questions from some folks over the last couple of days in Patreon also. I like the idea of real estate. I want to expand my real estate portfolio in the future. Right now, I hold none of it. My house that I live in, that's it. And honestly, they'll carry me out of this place in a bag. I'm never going to sell this place. I just like it too much. So, I don't own any investment real estate right now at all. My good buddy Chris Taylor over at Financial Prepper, him and Stacy were talking in one of their live streams this week about how they sold almost all of theirs. I think they still have one left that they just kind of held on to that as a hedge, I think, just in case they were wrong. But the writing is on the wall in real estate, folks. It's good things are not happening in real estate right now. And the Fed still has a lot of mortgage-backed securities that they need to unwind. And they haven't been able to roll them off because nobody's refining and there's not enough home sales. So the mortgage-backed securities are not rolling off the balance sheet at a rate that the Fed is aiming for, which means any day now the Fed could start actively selling those MBSs into the open market. That's going to drive the price of those MBSs lower. Remember, bonds, prices, and yields are inversely correlated, so that drives interest rates even higher, makes mortgages even more expensive. So residential real estate, homes, heck no. Commercial real estate, good God, no. Good God, no. I wouldn't touch any of those things right now. But, Mike, thank you very much for your support of the channel, sir, as always, and for your ideas and your suggestions and all the charts you sent me. And I just got a big old frog in my throat right now.
Okay, well, he's got a frog. So the 10-year, what you can do is you just double what the 10-year is, and that will give you a good idea where mortgages are going to be. Just a little thumbnail there.
Let's see. Where's my world government bond index? There you go. U.S. 10-year at 3.88. That is pretty close to what a mortgage would be. It might be a little bit on the high side right now. What's the average mortgage in the U.S.? Just under 7% right now.
It's 6.68. I think,
Oh,
and I
that's
think double that. That's 6.78. So it's pretty close.
all right. So we're in the right neighborhood. And while we're here, let's take a look at the yields. The U.S. 10-year yield chart, that was interesting over these last few weeks because Greg Manarino was talking about this a lot on his channel this week. We saw quite a drop in the 10-year yield over these last couple of weeks here. Since really last Friday. I mean, we were over 4% last Friday, and then in a span of 3 days, we went from like 4.1 to 3.57. I mean, like 43, 44 basis points in the 10-year yield in a span of 3 days. I don't know what the heck that was. Manarino is speculating that this is central banks are out there secretly through some back channel doorways buying up debt markets, which I can't rule it out. I don't know how they'd be able to hide something that big, but somebody was buying a lot of bonds in the first half of this week. Of course, now they're all selling it, whoever it was. Interesting. When you see volatility like that in a market like the U.S. Treasury market, which is supposed to be the picture of stability, that's bad. That means volatility is coming back. So whatever it was, it's not good. It's not good for us. And you can see pretty much the entire yield curve heading higher today. U.S. 10-year now at 3.88%. We haven't talked about commodities at all yet, Mish. I got to bring this one up here.
How are our friends in the repo doing?
How are our friends in the what doing?
Repo market?
The repo market. Well, let's take a look at the reverse repo real quick since you asked. 2.2 trillion, down a tick from last week. But remember, last week we would expect to be down from that because that was the end of the quarter.
That's three ticks.
Yeah, it's a couple of straight down ticks in a row. But to be honest with you, considering how high we're starting from, I need to see a meaningful move lower in this trend, not just one or two data points before I could say, hey, the Fed is starting to tap into that reverse repo cash yet. I think we're still a ways off of that.
I don't think they're tapping into it. I think some people are taking some liberties and risk.
Again, you smooth out this spike at the end of the quarter, right? Which we got. We're still pretty much right back where we were mid-September. I don't see the money coming out of the reverse repos yet. I mean,
what I'm saying is, you're right, throw it in there for the overnight, whatever, right, for the weekend or whatever,
right?
And then you pull back out and do something with it. And that's what I'm saying is they pulled out to do something with it, about 10%ish.
Could be, but again, this is a long way from a downtrend. Let's just leave it at that. There's still a lot of cash parked on Mars, and the Fed could take away that 305 basis points that they're offering on it, that risk-free return right now, and that money will come back into the short-dated treasuries. That's when the clock starts on the Fed pivot. When we see that happening, we can, at that point, I'll be willing to entertain the possibility of a Fed pivot. I think we are a long way off because, I mean, it took over a year to get from nothing to where we're at in the reverse repos. It could take that long when we finally do start winding it down. It could take that long to get to zero. So there's a lot of liquidity sitting out there. I just don't think we're there yet. Let's take a look real quick at the commodities situation going on right now. The dollar was higher today. Real quick, I'll touch on that one. The DXY, this is the U.S. dollar as measured against other currencies, mainly the euro, but also the Japanese yen, Swedish franc, the Canadian loonie, the British pound. All right, that's higher today. That's typically bearish for commodities. Commodities is a mixed bag today. Gold is down almost 1%. Silver is down almost 57 cents right now, down 2.74%. Still clinging to that 20 handle. Look, there's a lot going on in the silver markets right now. I'm trying to set up some interviews from some people who spend more time in the silver space and who study the exchanges. The inventory numbers are getting really tight. All right, the markets are being drained, but at the same time, you've got these bearish forces like the strong dollar, like the fact that stocks are heading so much lower, like the fact that there's liquidity problems and higher interest rates, right? So there are some really powerful forces at work in the precious metals market right now. I'm still inclined to think the prices are heading lower. All right. Now, I'm still in the long term super bullish on precious metals. When this debt bubble pops, if you're sitting there holding somebody's IOU, you're going to be broke. If you're holding precious metals, you will have wealth. It's really that simple. So I would rather be holding metal when that happens. But I think the price still goes lower from here. I think it goes a lot lower, although the inventory is getting tight. Somebody is draining that market. So it's going to be interesting to watch. And I am really just looking forward to that day that COMEX pops, because they've been rigging the price for so long. It's going to blow at some point. Just don't know when. Moving on a little bit from there, I want to talk about crude oil, 92.61, up over $4 today, or $4.65. The oil markets are just an absolute mess. Let me bring up that chart here. Here is the oil chart. All right, this is going all the way back to, this is about the end of 2021. Right, here was when the Omicron variant came out and oil sold off. This is all of the SPR dumping and these lower oil prices that we got all through the summer. This purple arrow right here, that is when I finally called the oil bottom. And if you guys have been following my live streams for a while now, you know, weeks went by. Every week on Friday, every Tuesday morning, I was talking about the oil markets and how I just wanted to call an oil bottom, but I didn't see it yet in the charts. And I was just waiting and waiting and waiting. Finally, last Friday, I called the oil bottom. I didn't nail it. I missed it by 2 days. Sorry, I missed it by 2 days. I can do better next time. But all things considered, I think I got pretty freaking close. And the reasoning I said, it was that OPEC October 5th meeting, that they were going to cut production. I didn't think they were going to cut it by that much production. But they announced a cut. They cut by 2 million barrels. Now, somebody mentioned, I think it was it Mike Kathman mentioned it in his super chat, that the actual reduction of oil production will not be 2 million barrels. They reduced the quota by 2 million barrels. Well, they've been missing their quota by 3.5 million barrels a day. So when you lower a quota that you're already missing by a huge margin, it doesn't mean you're really lowering production by that much. Bloomberg did the math, and they figured if they spread out that cut evenly, it would actually result in a net loss of about 880,000 barrels per day of oil. Still way more than necessary to send oil prices higher. And prices have rightly gone higher since then. Now, there's been a lot of talk in oil markets over these last few days. You've had another announcement from the Biden administration. Another 10 million barrels per day of oil is going to be dumped from the Strategic Petroleum Reserve. That is a desperate measure. It's not going to have any measurable impact on these prices. 10 million barrels is a rounding error at this point. That's going to end really within a couple of days of the midterms being over, a couple of weeks. They're considering dropping sanctions on Venezuela now to try to buy some of that oil. I don't know if that's going to happen, but look, folks, whatever they end up doing is not going to make up 880,000 barrels per day. And also keep in mind, OPEC could come back another month from now and cut by another 2 million barrels. So OPEC sent a message to the West. We are in charge of the oil markets, not you. You cannot fix prices. You can't rig prices. Supply and demand wins. And, you know, look, they're right. Until we start developing our own energy here at a higher rate, OPEC is in charge. So it was a no-brainer, in my opinion. And I just want to talk about this article I saw today. This is in Zero Hedge. As Biden welcomes Venezuela oil, he prepares to block all U.S. offshore drilling. Now, this is a little bit political in this article. There are a little bit of hyperbole here, but this is actually ongoing. I just want to read some of this. Yesterday afternoon, after reports that the Biden admin would ease if Venezuela would please pump more oil, Brad Huston succinctly opined on Twitter. So basically, Biden is saying that domestic producers are more evil than Venezuela's Nicolas Maduro. This morning, it appears the Biden administration is doubling down on that, as Fox Business reports that the Biden admin is nearing a decision on the future of federal offshore fossil fuel drilling and hasn't ruled out a complete block on new leases. On Thursday, the 90-day comment period for the Department of the Interior's proposed 5-year offshore leasing plan ended, paving the way for the agency to issue a final decision. And in July, the DOI unveiled the plan which gutted the Trump administration proposal, ruling out any leasing in the Atlantic or the Pacific and opening the door to an unprecedented scenario where no lease sales would be held through 2028. All right, so while we're dealing with this tightness in the oil markets, there is a decision pending, and if nothing changes, this will be the decision to ban any new exploration in the Atlantic or the Pacific for any new oil or gas. All right, so if you think there's going to be any kind of change in the leadership here in the States to produce more domestic oil, this should dash any of those hopes. All right, oil is going higher. It's going higher for a while, folks. Now, I've been talking for a while that this fall, oil was going to come roaring back, and it was going to happen right as it starts to get cold in Europe, and the natural gas situation over there is going to explode higher, and it's going to bring inflation back big time, and that is exactly what we're going to start seeing. And I want to show you this chart. All right, now this one right here, this isn't trading economics. This is U.S. consumer inflation expectations. All right, and I did a video a couple days ago, Wednesday, I think, about how it's inflation expectations becoming unanchored that the Federal Reserve is really afraid of. Once people believe prices will continue rising, then prices will continue rising. It's a self-fulfilling process. And that is the early innings of Ludwig von Mises' crack-up boom. And that's when high inflation becomes hyperinflation. And that is Jerome Powell's big worry. That's why the Fed is not going to pivot, because they're afraid of those inflation expectations. And the reason I talk about that is because look at this chart. This is the U.S. consumer inflation expectations. Now, keep in mind, this data only goes up to August. So this is delayed by about 2 months. But then look at this oil chart. Let me see if I can give you the same time pattern here. You see this chart. We're down here. We scale up for most of the year. We have a big spike in March, and then we come down. We continue up until about June, and then we go down all through the summer. Well, look what the inflation expectations do. They're going up pretty much all year. We have a big spike in March. We come down. We continue higher until June, and then we go down all summer. The inflation expectations is just basically the oil chart, folks. It's gas prices. That's what causes inflation expectations one way or another. And remember, the Federal Reserve, they've said it. Jerome Powell has said it in so many of his speeches. What he's worried about, his concern, is that inflation expectations become unanchored. He's afraid of this chart going higher. And if you look at the oil chart, oil just bottomed last week. And since the inflation expectations follow the oil chart, that means inflation expectations will be going higher along with oil prices. There is no Fed pivot coming. I can't say that hard enough. It is not coming anytime soon. The only way that pivot comes is if something god-awful happens in markets. And again, if you're one of those guys buying calls, thinking stocks are going to go higher because the Fed is going to pivot, those calls will be worthless if that happens. So this is not, again, not a financial advisor, not financial advice. Do your own DD, your own research, all that stuff. But this is not the time to pile into stocks blindly. All right, because inflation expectations will be going higher. The Fed will continue to tighten. And anything lower oil prices is what you need for this to continue lower. And oil prices are now continuing higher. All right, I got a super chat I got to catch up on here. Where is he? There is Mr. Dan Hadeen. Thank you, Dan, for the super chat. He says an oil exec in London came out today and said, be prepared for $12 gas. Yikes. $12 gasoline. Nothing moves at that price. Nothing moves. The trucks stop going because, I mean, if gas goes to $12 and diesel's probably, what, $15 at that point? No trucks on the road. Nothing's getting done. Everything from the food on the shelf to the guy who's cutting your grass, right, because the mowers need gas. Everything goes up in that scenario. Also, keep in mind fertilizer and food prices, folks. Food is just a derivative of energy. Food is fuel for us, and it takes fuel to make that stuff. Both the tractors at our farms and the fertilizer that goes into those farms is made from fossil fuels. So this means food inflation is going to continue also. So that's scary, Dan, $12 oil. Let's all hope that doesn't happen. But, Dan, I think he's probably right. Thank you very much, sir, for the super chat and the support of the channel as always. Appreciate that very much, guys. Let me make sure I didn't miss any of you guys. And I did not. All right. So we talked about the inflation expectations. It's now 4:01. Why don't we go through the indexes before we go any higher, because the markets are now closed. Looks like we caught a little bit of a bid at the end there. We closed just off the session lows. S&P down 103 for the day, or down 2.77%. At 3640, that is just barely positive for the week, I believe. And I mean just barely, folks. So we're right back where we started, right back where we were last Friday. Let's see with the Dow here. The Dow ends up closing down 629 points, or 2.1%. Again, just off the lows of the day. And again, just barely positive for the week. But importantly, closing the week below that all-important 30,000 psychological level. And lastly, the NASDAQ ends up closing down 420 points, or 3.8%. Terrible day for the NASDAQ, off its lows, but not by much. And for the week, the NASDAQ closed again just barely positive for the weeks. Now, look, if we're going to zoom out on this chart, this is scary because I haven't even seen it yet. I haven't even looked at this, but I know this is going to be ugly. Let's look at 1 week candles. Oy vey. Look at that filthy inverted hammer pattern right there. That is an ugly looking candle right there, folks, at the end. Let me zoom in on that a little bit. No, wrong button, Jack. See that one right there? That is an ugly, ugly pattern, folks. And if we go back here, let's look at the NASDAQ. Going to refresh this one. Yahoo Finance doesn't auto-refresh. Geez, you can almost even see a little bit of a head and shoulders there, can't you? Not that that's going to be a reversal, but that's, there's a little shoulder. There's a little shoulder. There's your head. Folks, markets are heading lower from here. Again, the only thing that is going to save these indexes, that's going to take them higher, is going to be a big surprise in the CPI next week. If we get a sharply lower CPI, then maybe these Fed pivot guys will be able to take the market higher. Maybe. Again, it'll be short-lived. It won't last more than a month, because by November, when those CPI readings come in, they are going to be much higher because gas prices are coming back because of that oil chart. And Powell is watching those inflation expectations. I'm telling you, this is the chart here. Where is it? This is the chart right here. Inflation expectations. This is the one Powell is worried about. And if those become unanchored, if these start moving higher, as they tend to track oil prices, that means we're looking at much higher inflation for the foreseeable future. All right, I want to talk about one other trade that I made this week. This one did not go well. And if I'm going to pat myself on the back for the oil trade, which did go well, then I have to take the my bad on this trade. I talked about this one on Patreon. And again, I talked about this one in the live stream last week, that I had bought some puts in UUP, which this is an ETF that tracks the US dollar index, or the DXY. And I bought those puts late last week, and they were doing pretty well right up until the middle of this week. And unfortunately, I never took any profits. I didn't close out that position until today. I ended up down about 34% in this one. So I saw that we had crossed above the 9-day average just at the close yesterday. That's why I have this circled here. This is the 9-day moving average shown on this chart. It had been acting as resistance. We closed just barely above that. And then this morning, as soon as we opened, I unloaded that position. So that trade didn't go quite as well. I had been calling for a correction in the dollar, and it just looks like it was very shallow and short-lived. The dollar looks like it's going to continue higher for a while, folks. So, well, you win some and you lose some. That's why I always say do your own research, your own DD, and arrive at a decision right for you based on your unique situation. Luckily, the returns that I got in the ERX calls and the Devon Energy more than made up for that one, but it was time to get out of this one, and I bought those calls pretty close to expiration, which is a classic Jack move to make. So we got out of that one. Another story I wanted to talk about is this one, and Mish pointed this one out to me today, and this is S Wholesale Inventories. This has been a growing problem for a while. Now, keep in mind, this chart is showing the month-over-month change. All right, so any positive number means inventories are growing. So you should historically be bouncing around between positive and negative as inventories fluctuate a little bit. You should never really have a sustained period of positive numbers in this reading here. And here we are now. was it 25 consecutive months of increases in inventory in the U.S. for wholesalers. All right, this is a very bad news for U.S. retailers. Wholesale inventories in the U.S. advanced by 1.3% from the month earlier to $912.6 billion in August, matching the initial estimate after a 0.6% increase in the previous month. It was the 25th consecutive month of growth in inventories. So this is U.S. consumers running out of money. There's just no money left at the end of the month. After we buy food, after we buy fuel, we're broke. And these inventories continue to build. I mean, the good news is this means cheaper prices. This means a lot of stuff's going to go on a discount. Mish, you were talking about you got a pretty good deal on a TV today. That's great. You know, this means cheaper wants as the needs continue to get more expensive, something David Morgan was talking about in our interview at the Silver Symposium.
Hey, if you get a second, can we go through the bond market?
The bond market, U.S. bond market. Here we go.
Yep. Take a look. People are asking.
All right. I have got, well, it looks like everything just reset because we didn't get that big of a move. Looks like the 10-year 3.88. I've got most of the middle of the curve is back over 4 now. That's interesting that you've got this dip in the 10-year. And looks like the 3-year 4.34. You're testing me, Mish. What am I supposed to be catching here?
You're not catching anything. You're just looking.
Okay. Not a whole lot happening in the bond market this week. Well, no, I have to take that back. We saw a 40 basis point drop in the 10-year this week, something I talked about before. And then it looks like we got back about 30 of them. So quite a bit of volatility. Let me zoom out on this one here. This is the 10-year yield going all the way back since the start of the year. This is ugly, folks. This is the U.S. This is the cost of money rising. Interest rates are rising, and we live in a debt bubble. Servicing that debt is becoming more expensive. We have a lot of zombie companies that don't make money. The only reason they exist is because they've been able to access the debt market to borrow money to finance money-losing operations. Companies like Peloton just announced another 500 job cuts. Sorry, nobody needs a $50,000 exercise bike right now. It's a little exaggeration there. I don't think they're 50,000. They might be 48,000. But Peloton is a perfect example of why I use the NASDAQ as an indicator, because companies like that just won't be around very long with interest rates this high. So we need to burn off these zombie companies. Unfortunately, that means unemployment going higher as people lose their jobs. But hopefully you get healthier, more productive companies take their place, because we now have a debt market where you can't just borrow money and create some crap company. You need to actually produce some kind of value for people in order to meet the cost of borrowing money anymore. That means slower growth, but that means better growth. That means more sustainable growth. So ultimately, as long as the Fed doesn't pivot and lower rates again, you will get a healthier economy coming out of this thing. It just means it's got to get a lot worse between now and then. And something else I wanted to talk about to the tune of those wholesale inventories. I saw this story in CNBC today. FedEx ground to lower holiday volume forecast, according to an internal memo. Now, FedEx is already down like 42% year over year on their stock, or year to date in their stock. And then this one came out today. The FedEx division that handles most of the company's e-commerce deliveries plans to lower volume forecasts because its customers plan to ship fewer holiday packages, according to an internal memo. So FedEx, I did a video about this one a couple weeks ago. FedEx is widely viewed as a barometer for the health of the U.S. consumer. FedEx is getting ready for the U.S. to consume a lot less stuff. So this is very bad for the market as a whole. And when you see retail inventories rising for 25 consecutive weeks, and then you get FedEx getting ready to ship fewer packages, what does that tell you about the health of the American consumer? Not good. And again, if you want people to come back to work so that they have money to consume, you got to pay them enough. So the Fed should not be fighting to keep wages lower right now. They should not be doing that. A little wage spiral inflation, after printing trillions of dollars and driving all this asset inflation, I think we can cut people a break and give them a little wage inflation. I just throw them out there. You do what you want with them, Jerome. All right. I think I had one more thing. Oh, yeah, this one too. Another indicator as to the health of the consumer. Chip makers see breathtaking drop in demand as recession looms. Samsung and AMD numbers miss projections. Taiwan Semi bucks the trend, but latest weak results stoke fears that a recovery is further out. Again, chip makers, these days there's chips in everything, so you could view this as a reduction in the demand for just about anything. Signs are piling up that the tech downturn may be deeper and longer lasting than feared. After years of record capital spending, chip makers are warning on a weekly basis that demand is sputtering. In the latest sign of trouble, Samsung and AMD reported disappointing results within hours of each other that widely missed projections. So, inventory piling up, fewer packages getting shipped, fewer orders for chip makers. That's your upstream, right? The chip makers, they make the parts that go into the next stuff that's going to get made. So across the whole supply chain here, folks, you're seeing a slowdown in consumption. And we are in a consumer-driven economy. Again, there's nothing good on the horizon for U.S. markets. All right. I missed somebody. I missed my man Zarkos. Oh, and I missed Mike also. Wow. I'm sorry, guys. Me and my big mouth. I'm missing super chats now. I have got Mike Binder from Robin RC Models again. Thank you, Mike. He says closed UUP in profit. Congratulations, Mike. You did better than I did on that trade. Everything will become more volatile. Wouldn't be surprised to see the price move opposite right before CPI. Yeah, markets always, you tend to get some front running in CPI. And, I would also caution, avoid trying to make any trades in the first few minutes after CPI also, because you always get these big algorithm-driven moves in markets. I don't get involved in that noise. I sit back and I watch. There's going to be plenty of time to reposition and reevaluate your trades after CPI. Don't try to wrestle with the algorithms. You're not going to do well. But congratulations on the UUP profit. Again, you did better than I did on that trade. I got my hat handed to me. Luckily, I was able to offset that in other ones. But it looks like for now the dollar's probably going to be heading higher, especially looking at that chart of the British pound that somebody was asking about. Sure seems like the trouble in the UK is not yet behind us. Thanks again, Mike, for the support of the channel, sir, as always. Oh, and by the way, Mike, if you don't mind, Mike sent me a message today in Patreon. It was a really good one. I'm going to butcher your quote, Mike, but he said, the Fed is trying to steer a massive ship, the U.S. economy, which is moving ahead at full steam, and he's trying to do it with a tiny little rudder. And I know I butchered that quote, but I just remember reading that and saying, wow, that is the perfect metaphor for what they're trying to do. They're trying to steer a huge, fast-moving ship with a little bitty rudder, and anybody who's ever spent a lot of time at sea knows it's not going to work so well. So thank you, Mike, both for the support of the channel and for that fantastic analogy that I'm sure I just butchered the quote, but you can imagine what I was trying to say. Mike's a sharp guy, folks. What's that, Mish?
I've never been to sea.
Oh, yeah. You never been to sea? I don't know. You might be a lubber now, but you're a Navy. You're a Navy boy. The salty dog, that Mish.
15 years of sea time.
If you can call that a boat. You were on a ship, not a boat. I was on a boat. I spent a lot of time at sea just like Mish did. My boat was a lot smaller and a whole heck of a lot dirtier. I was a fisherman. Mish was in the Navy. And somehow we both ended up working on nuclear reactors.
Hey,
weird courses we chart in life.
Want to say hi to Ortwin? He's in the chat.
Andy Ortwin? Hey, Andy, how's it going? Ortwin International is one of the guys I met at at one of the Ninja Nation events in Denver and then again in Dallas. Hey, Andrew, it's always good to see you, sir. Thank you for checking it out. And I got to send a shout out to my man Zarkos, 26,000 on the Dow Jones very soon with a big told you so. All right, let's take a look at the Dow chart, Zarkos, 26,000. I'm going to give you a yay or nay on 26. Definitely a yay. The question is when. Yeah, we're going to 26. Maybe we have a little bit of resistance somewhere in the mid 27s. I'm looking at that high from June of 2020. Looks like that level right around 27.5. Once we break below the current levels, I would say 27.5. You might have weak support there. We blow below that, then yeah, your 26 number, absolutely. So Maybe it takes us another month or so to get there, but 26, I think, is in the cards, Zarkos. Absolutely, sir. And congratulations again on the champagne bath. I know Zarkos has been doing pretty good lately. Thank you, sir, for the support of the channel as always. And did I miss another one? I don't think I missed anybody. I am caught up. Thank you, Mish, for that one. All right, guys. So it's 4:15. We've been going for an hour. If there's one thing you take away from this whole channel this week, it's been the recurring theme that no pivot. All right. The Fed's not pivoting. Inflation is coming roaring back this fall. It's going to come back hard and fast. Everybody's going to act like, oh, I was so surprised. Who saw this coming? And the answer will be Jack, because Jack saw this coming. All right. Inflation is going to be a lot higher. We might get a lower print next week. We might catch a bounce off of that lower print. It will be short-lived because the Fed knows expectations are going to rise. They know now that oil is heading higher. They can see what's coming in Europe. Higher inflation prints for the foreseeable future. Thank you very much, Mike Kathman, for the support of the channel. He says, bad news brings out the best in us. Uncommon Sense and Onsite Trav, our blue-collar brothers, doing what needs to be done in Florida. Thank you, Mike, for mentioning those guys. I did see Sandy C. was in the chat earlier from Uncommon Sense and Onsite Trav. He's been on the channel before. We've been talking with him. Two really good guys out of Florida. They were right in the path of this storm, and both of these guys are out there doing the work to actually fix things from the storm. They're not on Twitter complaining, why doesn't somebody do something? They're not arguing and pointing fingers at somebody else. These guys put on a pair of gloves, a hard hat, and actually went and started picking up some of this crap. Good on you guys. That's where you want to be, all right? I mean, there's no shortage of people demanding some action being taken, and there are very few actual doers in the world. And I just want to say change happens at the local level, all right? As a great speech by a guy, Admiral William McCraven, it was a couple of years ago, said if you want to change the world, start by making your bed. It was a very long, very good speech. It was at a commencement. I can't remember where, but he made a book. He wrote a book based on that speech. I read it. It was excellent. And it is all about how actual world-changing change is made one little tiny incremental win at a time, and that starts with making your bed in the morning, something I didn't do this morning. Sorry, Admiral. But the message is, get your own house in order first, and then things go a little better for you. Now you can worry about what happens outside, and then worry about what you can affect the second you walk out the door. Don't worry about what's happening halfway across the world. If you take these little incremental steps, eventually you can reach the point where you're making that kind of change. So to see guys like Sandy C. and Trav out there doing what they're doing for the hurricane relief, that's a great point, Mike, and thanks again for pointing that out and for the support of the channel. But go check out those channels, Onsite Trav and Uncommon Sense. Those guys deserve a follow because they are doing the good work, fighting the good fight. Keep it up, guys. And there's one more time. There's my man Zarko says, I missed the beginning, so I don't know if you spoke about it, but I believe the real estate crash will help the markets go lower. I agree, sir. It will. I don't know if real estate is going to crash or if real estate is just going to perpetually grind lower. Right now, real estate is perpetually grinding lower, very so slightly. Homes are unaffordable, and so the market is like frozen in place. Well, so that's got people sitting still. People are not selling their house. They're not moving. They're not trying to upgrade because they can't afford it. Well, as long as there's no big wave of layoffs, the housing market isn't going to crash because people can afford the homes they're already in. So it's going to take a wave of layoffs to get an actual crash. However, the market will continue going lower because you always have people at the margins who are moving because of work, or people who lose their jobs or quit their jobs, or like guys in the military that are always being moved around. So those people at the margins that are always going to be buying and selling homes anyway, they will be taking the prices lower steadily for the foreseeable future. As long as these payments remain so high, they won't be able to afford the asking prices. So I don't know if we get a crash, but we will get a sustained move lower. The missing ingredient to a housing crash is a wave of layoffs, and based on that jobs number today, not happening just yet. But thank you very much, Zarkos, for the support of the channel. I did mention real estate briefly, but not really that in depth, but I appreciate that very much. And my man Crushing Bear is back. Thank you, sir. He says, hey, Jack and Mish, next week we'll kick off the bank earnings. Good point, Bear. You think going to be bad? Which bank is in trouble? Reduction of mortgage. I'm not worried about U.S. banks. I don't think their earnings will be great, but look for the banks to make some kind of warning. They're going to be asked about the pension situation, I'm sure. They're going to be asked in their earnings calls about what's going on over at Credit Suisse. There's going to be a lot of questions about that. So look for the CEOs who give wishy-washy, soft-worded CYA kind of answers to questions like that. Now, I've been saying bank earnings will be bad for the last 3 quarters. They have been bad for the last 3 quarters. They were really bad last quarter. They were down like 45% year over year for some of these banks, and yet the stocks went higher. So I don't want to make any call on the direction of those stocks. They're going to go with the direction of the overall market, regardless of what their earnings are. But I don't expect good things from banks. The question is, do any of them let their cards show and signal some kind of systemic weakness behind the scenes? That I'm interested in. So next week is probably a good week to listen in on some of those earnings calls and see if you can pick up on maybe some unspoken liquidity problems or credit risk or non-performing loans starting to pile up. That's the kind of stuff I'd be looking for with the earnings next week. That's a great point, Crushing Bear. Thank you for pointing that out. And I'm finally caught up. I think I'm going to call it there, guys. I didn't miss anybody, right? Nope, I got them all. All right, guys. Thank you so much for the support of the channel. Thank you guys for your generosity in the super chats. Thank you very much to my Patreon supporters. Link down below to that if you guys feel so inclined. Again, had some great discussion on the Patreon page this week. Thank you guys for everything you do, your ideas, your emails, your messages. Have an awesome weekend. And until next time, Mish, you got anything?
Hey, find me in the wild. Get a Merc time.
All right. Get a Mish Merc. Got to catch up with him in a while. He is in, where'd you say you were? What part of Texas?
Home of the best barbecue in the world, Lockhart, Texas.
Ooh, you just triggered a lot of Texans in other parts of Texas with that one.
Really? It's on
All right. All right, guys. Have an awesome weekend. Till next time, live small and dream big.